Welcome, everybody, to the Chinchilla Picking podcast. As always, we hope to be entertaining, educational, and uplifting because we want everyone to make money. Rules, guys. Brandon and I get together 5 minutes before the show, and we tell each other what we're going to talk about. You hear the live discussion here on the show. We hope you enjoy it, and if you do enjoy it, please hit that subscribe button to subscribe on what other streaming service you're using to listen to us. We appreciate the follow and the subscribe.
Hit the subscribe button, Mom. Gosh.
She's the only one who's not hitting it. Can you please, ask her?
The only one listening.
Right? Sorry about the lack of content last week. We're going to work better on that. We have a good plan, and we're trying to work on that. There was just a lot of things going on. Let's get to it, man. Crypto. Brandon, I know you have a not a negative, but like a sour taste in your mouth when it comes to cryptocurrencies, and you're skeptical, right? You're cautiously skeptical. And like a lot of people are, right? A lot of people are, and a lot of people are don't really understand it, and that's what makes them not want to get involved, right?
I don't know that I have a sour taste in my mouth. I've traded Bitcoin a couple of times. I traded Doji when that whole thing was going crazy because everybody was trading it, and it was I don't want to say easy to trade, but it was easy to trade. It was, but when you get a 30% gain pretty quickly, you got to take it, right?
Right.
But it can be very hard when you get in your own mind sometimes, especially if you're a new trader, especially if you're doing something that you have never done before, like trade Doji, and you get a huge 30% gain. You're like, my gosh, yeah, is it going to go higher? Should I take it now? Should I take it now? Should I take it now? That stuff like that. So which is why you really have to have a good strategy and follow that strategy to a T and not let your emotions get in the way. But anyways, I'm just kind of in a wait and see moment right now with crypto. With inflation on the rise, I want to see what Bitcoin does.
Gotcha.
It's stuff an inflationary environment right now, and one of my theses was that Bitcoin was built to beat inflation, and I just want to see what happens.
And I sort of agreed, but disagreed with you on that point last week, where I don't believe it was. Yes, at the end of it, after we talked through it, I guess I kind of agree, but like that's not the purpose for buying it, is to beat inflation. The purpose for buying it was to have your money in a currency that is not controlled by a government.
Yeah.
And
well, let me say this real quick. So if there were some people out there that was saying that Bitcoin would beat the US dollar and all that, and of course, right now we're looking at Bitcoin. It's down 36% for the year while we have rampant inflation going on. However, for the past 5 years, it's up 3,241%. So if you look at that, did people front load into this? Did this prediction?
It may have predicted inflation, but I think it may have predicted more of a mistrust in government for that aspect. And right now it's still beating US dollar. It takes $40,000 to buy one Bitcoin. So I would say that's a definite beat in my definition of beat in one currency, beat in another currency.
Yeah. So, like as you said, there's many reasons to buy cryptocurrency. What I was just talking about is just one of the many reasons to buy crypto, or one of the many reasons people have to buy it. But my question is, will the trend that it's in the past year, 36% is what it's down by, will that reverse? And
sort of answer that, but I also wanted to talk about there's a yes and no to this. Yes, cryptocurrencies will bounce back up. Will it be Bitcoin? I have some investment in Bitcoin. I believe Bitcoin's going to continue to move higher because that's the mainstay, right? But there's so many cryptocurrencies out there. It's like with any new market. Remember the .com bubble? I don't know if you remember. Some people might not remember. But when the internet first came up, everybody just kind of said mouse.com and cars.com and house.com and pins.com. And, most of those websites are no longer in existence for a reason. There was a million different websites that popped up and they're no longer around. And so that's what a lot of people feel is going to happen with all these cryptocurrencies. So my point is, what is the future of the cryptocurrencies and what can be a sustainable way to do it? Let me talk about some of the different ones that are out there and kind of like how they're being used, right? So there's Ethereum, right? Ethereum, and that's one a lot of businesses are using to secure their technology is using that blockchain technology with Ethereum behind it. And so it's being used in that aspect. That's why it's gone up in value, because major companies are utilizing it in that way, right? Bitcoin's being used just as a buy and sell, purchase. It's not being used to secure systems. And so there's different uses for different cookies. Now you have to own some Ethereum in order to make that work. And in that same thought process, let me talk about a new one that's come out and how it's being currently used. There's one called Polkadot, right? A lot of people are talking about Polkadot. This was actually brought up to me by a friend of mine. She texted, I believe you and I both, in a text about, hey, do you know anything about Polkadot? And at that time, I was like, no, it's just another cryptocurrency.
Yeah.
And she had heard about it. She asked me about it, and I didn't know at that time. So I did some research, and I looked into this, and I looked into some more. And then when I opened my crypto.com account, which I'm going to get into if I'm going to keep that or not keep that here in a few minutes, Polkadot was one of the ones on there. And Polkadot was one of the ones that crypto.com was going to give me a percentage return on if I allowed crypto.com to use Polkadot. So they call that crypto staking. When you allow a company or a blockchain to use a particular coin and they give you coins back in return, it's called staking, crypto staking. Now, what are they typically using those coins for that you're giving them? So let's take Polkadot, right? I want to use that one as the main example here today. Polkadot is I give the system 10 Polkadots, they use that to verify other Polkadots and other exchanges and use it as both to verify exchanges from one person to another and to secure systems. So Polkadot's being used for that. And every time I allow them to use that, the system, the AI that's been generated and let loose will automatically give me rewards in Polkadot for allowing it to be used. Do you understand? And so that's why Polkadot staking right now is very, very, you get favorable returns. Right now, they're looking at you can find around 20% APY returns on your Polkadot staking, which is a great return for a year that beats the S&P, and you could just be staking Polkadot year round. The problem is Polkadot, unlike the last time I talked about staking, I talked about using the USDC coin because it doesn't move, right? It's stable, $1 for one coin. Polkadot is a cryptocurrency, so it's going to move. So what you're hoping is that it will always move higher because people are getting these high rewards for staking. You're expecting more people to own it and keep it and hold it. And then you're expecting more companies to use it because there's a lot of users out there allowing you to stake the Polkadot. So the thought process was for continued growth in that cryptocurrency, in that coin. So I bring this up to show you how some coins have a brighter future than others because there's an actual use for it. And then others, such as Doge, have no actual use. It's meant to be just a currency, but why would you use that currency when I could use Polkadot or Ethereum that actually has a use and people are going to continue to use it? Thoughts real quick on all the information I just threw out at you.
So here's my strategy. All right. I'm going to go around and ask all of my friends, okay, which one's buying GameStop for the long term? Okay. And then whatever cryptocurrencies they're in, I'm going to stay away from, and then I'll be golden. So all three of my friends, Dave, my girlfriend, and my mom.
I am not buying GameStop.
So are you long GameStop? Okay. What cryptocurrencies do you have? And then I'll just not buy those. Now, I mean,
do you understand what I'm saying and how I explained it? Was it kind of clear?
Yeah. Does Polkadot trade on what's the major crypto wallet?
Coinbase, crypto.com, Binance. Yes, it trades on all the big ones.
Not on Robinhood, but
no, not on Robinhood.
Okay.
And on Robinhood, you actually don't have a wallet. On Robinhood owns the coin. So on a lot of these, like crypto.com, if you don't have a wallet that you use and you just use the crypto.com's site, then you actually don't own the coin. You're just trading the coins that crypto.com owns.
Robinhood, aren't they coming out with a wallet? Weren't they?
They are, yes. So yeah, they're coming out with a wallet. Most sites like Coinbase, Crypto, Binance allow you to use a wallet if you have one. But if you don't have one, they'll be more than happy for you just to buy and sell the coins they own. and they make a percentage off of it, and it's free money for them basically. I mean, you have the choices with the other ones. You don't have that choice with Robinhood.
Gotcha.
But I mean, I just want to make sure people understand that, like, when you're looking at a cryptocurrency, look to find one that has a use. Look to find one that, actually serves a purpose, right?
Yes.
Now, Bitcoin is more of just a currency used to buy and sell, but it's so big and popular, and it's everywhere, and it's accepted at so many different places that I still believe in the future of Bitcoin because of that, because it has grown to arenas and football games and Ticketmaster and so on and so forth, because you could use it at all these venues and sites. I mean, it's going to be something that will continue to be used going forward in the future. A couple things that you told me what they were, but you didn't really go in detail. So I want you to go into some detail on this, but go ahead, take it over.
So I started a book recently, and I don't know how this, like, for the past, like, I've been trading like 15 years in investing, and I don't know how this book escaped me, but it did until recently. And it's What Works on Wall Street by James O'Shaughnessy. And it was written, I believe the first edition was back in 1996. Since then, they've had 4 new editions to update the data and all of that. It's interesting because the data just continues to show kind of the same thing that he originally came up with in 1996, that the patterns kind of stay the same. So what he did is he took the most popular strategies on Wall Street, and when possible, he went all the way back to 1929, back tested them to see what works and what doesn't work. And he also did the same thing with the value ratios that we use, like price to earnings ratio, price to book, cash flow, and price to sales, to see which one is the most effective tool to beat the market with. Price to sales is actually what became the most effective valuations, and what has worked since 1951 is what he was able to back test to. And I think the end date on this was December 31st, 2003 on the price to sales. So he went from December 31st, 1951 to December 31st, 2003. And just so in case you don't know what a price to sales ratio is, it's calculated by taking a market capitalization of a company, so the market cap, and you divide it by the company's total sales or revenue for the past 12 months. And that's what you get, price to sales. That's how that works. $10,000 invested on December 31st, 1951, in the 50 lowest price to sales ratio stocks grew to $22,012,919 by December 31st, 2003. That was a return of 15.9% a year compounded. The strategy performed well over time. He says, this is reading directly from the book, the low price to sales ratio stocks beat the market 8% of all rolling 10-year periods. Are you raising your hand?
So I was. So you said that was compounded. So it's 15% compounded. It's not just a straight 15, right? Every year for that whole length. So that's actually, if you're a long-term investor, that's great. Those are awesome returns. I mean, you could literally put $1,000 in there and in 25 years come out with millions.
Yeah.
If you're compounding it, if my math is right, it could be wrong. My math could be wrong. I'm not a mathologist here, but yeah, those are great returns. That's a great strategy, and that's going just off using the price to sales, right?
Lowest 50 price to sales ratio stocks in the stock market, and he rebalanced it every year.
So lowest 50, and you have to rebalance it yearly.
Yeah, that's it. Just touch your portfolio once a year, rebalance it, and 15.95% average return.
That's wow. That's incredible.
On the opposite end of this, the worst performing stocks happen to be the 50 stocks with the highest price to sales ratios. So $10,000 invested in December 31st, 1951 was worth just $19,118 at the end of 2023. This is the worst performing set of stocks that he came up with by far. 1984, he said, was particularly gruesome. $10,000 invested in the market grew by more than 50% if you invested it in just in the total market to $15,416. But an investment with the 50 stocks with the highest PRs fell by 70%, turning $10,000 into $3,079. So if you would have started at 94, then it would have been even worse.
Yeah, because it's the 1984, it's a
Yeah.
bad year to start anything, right? Inside joke, sorry.
A central theme of this book is that all strategies that work will have periods in which they don't work. So you just kind of stick with it. You have to be patient and you have to, just let it work over the long term. On 5 occasions throughout the time period, the 50 lowest price to sales ratio stocks lost 30% or more. And 3 of those situations, the declines came rapidly. But the low PSR strategy beat the market more times than any other value ratio, and did so more consistently. Wow, I'm gonna have to edit that. Well, even though,
Or you can let people hear your mistake and let us know you're human and not a robot machine.
okay, I'll do that then. So even though 88% of the time this beat the market, there is that 12% of the time that it doesn't, and there's a few times probably recessions or depressions, the 5 times where it lost 30% or more, but it recovered it, over time. So you have to be patient, you have to be prudent, and you have to stick to your guns and stick with it. That's kind of his key and his central theme throughout the book. You find the strategy that works best for you, you stick to it, even through the bad times. That could be hard for a lot of people to do. Even especially market managers, is one of the points that he makes too. Is one of the reasons why market managers perform poorly compared to the S&P 500 is that they have a lot of customers that lose patience very quickly, and they have a lot of bosses that lose patience very quickly, and that leads to good market managers being fired fairly quickly for sticking to their guns.
Yeah, I mean, it's a sad but sad reality of the market as a whole. Because I mean, we're not saying what we know we works, and I give this example of for us here. I'll use our own personal lives examples, and I do this not to boast, but to let people know. I've been trading or slash investing in NVIDIA for I don't know how many years now, Brandon, since Facebook group, and I was posting on there all the time. And NVIDIA is one. It's like I know that company in and out, and I know when it's undervalued, and I know when to buy, and I know when it's reached a point where I'm kind of like, okay, time to take my profits off the table. And it's because I know that company in and out, and I watch the board of directors, who's coming in, who's leaving. I watch the CEOs and the executives, and I know that in and out. So I stick with the companies I know, and I stick with the sectors like semiconductors and oil and the banks. I understand how these all work, and I trade those regularly, and I stick with them. I don't go out of it. Yes, that's a very generalistic explanation and view of what you're trying to get across, but I believe it's a good example also to give.
So what you're doing when you buy those 50, you're diversifying your performance, as far as like there's going to be some stocks that fail and some that don't. But what's interesting is it doesn't really diversify by sector. So if you did that today, mostly what you're going to get, a large majority of your portfolio would be home builders and financials and insurance. A very large percentage of it, in fact. So I ran a screener based on this test here to see what would come up. Before I get into that, let me say this one interesting thing. Usually people say that the small caps are more speculative and they perform worse than large caps, right? The small caps, with using the 50 lowest price to sales ratio, and the small cap actually perform better over time than the smallest large caps. I thought that was interesting. Both of those groups beat the market over the period, and it gets even better when you combine them. But if you separate the large cap stocks and you're just looking at the small caps, the small caps did better. Go ahead, Dave.
And that doesn't surprise me. And it's because the small caps have much more room for growth.
Yeah.
Right. So if I'm trading, if I would never trade. Well, actually, I have traded Apple. I would invest in Apple, but if I'm trading a big cap company, say Tesla, right, I'm looking for a 2 to 3% because I think it's going to move that. And it moves pretty much 1 to 2% daily, up and down. And if you could day trade that over and over and over again, you're going to make a lot of money. That's how I look at that. I don't look for big returns on the big caps because there's not a lot of room for growth, or there usually isn't.
Right.
So there's more room for growth in the small caps because they're either just starting out or they've only been around for 5-7 years. They have a lot more growth to grow into their close. They're still teenagers and not full grown yet.
But in general, if you're investing in small caps, you're going to have a larger percentage of those stocks fail. but it seems to be
for the same reasons I just said too.
Yeah, but it seems to be that using the low price to sales ratio here, which and anybody who says low price to sales ratio, you're usually referring to anything with a price to sales ratio under 1. But we're looking at the bottom 50 as far as the lowest price to sales ratio goes. It seems to be that kind of filters out a lot of the small caps that do fail. So it kind of makes it, it kind of adjusts your risk to a better risk return there. Now like I said, I ran a screener here for value stocks based on the lowest price to sales ratio stocks. What I noticed is that any company that did not have sales showed up on my list as well. So it would just show up as a price to sales ratio of 0. So I wanted those out because that doesn't make any sense to have those. It's just that's an error on TD Ameritrade's part to let them show up as a price to sales ratio of 0. It's because they don't have a price to sales ratio. So what I did to filter those out is I filtered out anything that did not have a price to earnings ratio. So if it didn't have earnings, it didn't show up in my filter. So the 50 lowest price to sales ratio stocks with the true price to sales ratio, and I'll just say some notables that appear on this list. I'm not saying that they're buy or sells or anything. Show favorite Jeffries, which I still think is a buy. So I will say that. I've already traded it. I've gotten out of it already. I might think about getting back into it. But Jeffries showed up. Honda Motor Company showed up. Lincoln National Insurance, Oppenheimer Holdings, and Foot Locker was actually on there as one of the lowest price to sales ratio stocks.
I'm blowing the whistle on Foot Locker there.
I swear.
No. I'm not touching that. I mean, maybe I'm dead wrong here.
You might.
I'm just like, I'm not touching that.
It is a low price to sales ratio. I'm not. So when you say buy these 50 lowest, right?
Yeah.
So that doesn't work out. Some of those stocks won't work out. Foot Locker might be one of them. But I was just saying it was interesting that it appeared on that screener there. Another thing that he was talking about, he talks about the strategies that people use other than just the ratio. So the dogs of the Dow is one of the best known and simplest investment strategies around. And this is straight from the book again here. So I'm not, breaking any copyright laws or anything. I'll say it's straight from the book. He says, start with the 30 and only famous blue chip stocks that make up the Dow Jones Industrial Average, and then sort them by dividend yield from high to low. Once a year, buy the 10 that have the highest dividend yield. Hold them 1 year and repeat the process, replacing any that have fallen off the list with the then 10 highest yielding Dow stocks. That's it. He says the simple strategy has been a market slayer since 1929, constantly beating the S&P 500 over all but 2 rolling 10-year periods. So it's got 80%. 80% of the time it's beaten the market. And he even looks at the media. He goes back and says, okay, this strategy wasn't working in like 1992. There's a couple of years of the late 90s when we had the dot-com bubble where it didn't work. And the media quickly turns on any strategy that's not working for any given year. He talks about the time writing an article that says that the dogs don't hunt anymore because it was just like 1 or 2 years where it didn't work out. And so people lose patience with strategies the minute that they seem that they're not working anymore. But he says, keep in mind, what you have to do is keep a long view here and look at 10-year, 20-year, 30-year periods, strategies that work for those. 1 year, 2 years shouldn't matter that much to you.
I mean, Brandon, if everybody had the longer view and was willing to, invest in these companies and follow their strategies year in, year out without fail, I mean, you got to have some people who are Carl Icahns and Warren Buffett's and Bill Ackman's. You can't have everybody be in that group. I mean, people do pull out and it doesn't work for me. It didn't work this past month. Well, I mean, it's worked for you the 12 months before that.
Most of the legendary investors have a strategy and they stick to it even
exactly
the downsides.
Exactly. And just to back that up, guys, for anybody listening, if you have Hulu, there was a thing on Carl Icahn on Hulu that I thought was very well done. Yeah, there were some things I disagree with, but most of it I agreed with. And, go watch it. It's a good watch. It's a documentary. It's Carl Icahn's doing the interview himself. So watch it. It's great. You might get something out of it, you might not, but I hope it reinstalls the point that Brandon's making right now, which is, if you're going to follow these strategies, follow them. You may have a down moment or two, but stick with it. You'll make money.
Yeah. Well, and oftentimes you're buying a beat down stock, the stock is going to get beat down for a little bit longer. You're not going to catch the bottom on it. We've talked about this before in the past. So, if you buy a beat down stock, like I often do, in the coming month, it may be down more. But if you've got a long-term view on it, then just hold it. Don't let your emotions play.
Right. Hey, Brandon, I tell you what, man, you always end up right in the end. So with you, I always feel like when you first get into stock, I'm like, it's going to go down a little bit more at first when Brandon just got in. But you typically are right in the end. I will give you that. Typically.
Except China. China sucked.
You did get hit by China last year. That was
terrible. Read in investing are very general. A lot of them will say the same thing over and over and over again. And I kind of got in that rut where the books that I was reading, they were all good, but they were just all repeating what the other books that I had already read said already, So I was really looking for something that had some strategy spelled out. Okay, tell me what to do. Don't tell me what's not working in the market. Don't tell me that that value stocks over the long term outperform, because this is all stuff that's already been in other books, the last 10 books that I've read. So, give me something more technical to go by. Give me something more detailed. What works on Wall Street is that. And then Warren Buffett and the interpretation of financial statements. So what works on Wall Street and Warren Buffett and the interpretation of financial statements. If you're looking for something more detail oriented, something that gets into the red meat of it, those are the two books that I would recommend.
Nice. If you want us to come to your college or university, let us know. I want to say hi to Charles, new listener. I told him I would do a shout out. Hey, Charles. Charles, if you want us to come to your university, let us know. We'll be happy to come over, set up a booth, and talk about stocks and investment. Yeah, right. He's gonna get a kick out of that. But yeah, we'll be happy to, guys. And when I do the post on Instagram and you listen to the show and you see the post on Instagram, I want you to comment if you want Brandon and I to write a book. Please leave a comment, man. If we don't get any comments about Brandon and I writing a book, then we might just not write a book. So,
and that would be a travesty.
I know we want to write a book, because as you flip from Brandon's page to my page, you're just going to be confused. All right, guys. Well, as always, we hope we've been entertaining, educational, and uplifting, because we want everyone to make money. Have a good night.
The United States are in a little bit of trouble. It's a lot worse off apparently in the UK right now, but just here in the United
States. Yeah, that news, all the headlines I've been reading out of the UK. So glad, proud to be America. I
mean, pension funds are they're in a death spiral right now, selling as bond prices are decreasing and interest rates are going up. So right now, it looks like there's some sort of popular investment strategy, ability-driven investment strategy. It's actually derivative-based investment strategy. And derivatives, that's a hot word for those of us who grew up during the housing. That's
I was gonna say, it's always a derivative that brings us down.
Never underestimate the ability of the smartest people in the world to screw us all over. Find some very intelligent way of investing to ruin the world.
Hey, try to explain what it is. I know you don't fully understand it. I know I don't really fully understand it either. But do your best right now and try to explain what it is this vehicle that they're investing in, and then how it affects pension funds to your best of knowledge.
Here's the thing. I found this 5 minutes before me and you started the show. And I was looking for things. This was a Wall Street Journal article, and this popped up, and I thought to myself, "Oh gosh, this is not good." So in the article, what it says is the LDI strategy is what it calls liability-driven investment strategy, is meant to help pensions more efficiently manage their assets to ensure they can pay future retirees. Pensions use an LDI manager who buys interest rate swaps and other financial instruments to hedge against risks that falling interest rates and rising inflation will increase their future obligations. The problem here is We don't have falling interest rates anymore. We've got rising interest rates and very high inflation. And if inflation's peaked, with rising interest rates going up at the same time as inflation might be peaking, we might be facing some deflationary pressure on the other end. And that's even worse from what I'm seeing here. But I just don't know what these interest rate swaps are well enough. And I don't know, I found that Japanese pension fund that was selling off US treasuries last year. It was really to the extent of my knowledge as to as to how much I've ever researched pension funds.
A swap. So I know this. And I know this, guys, because I watched The Big Short. But during the Great Recession, Michael Burry created a mortgage-backed security swap.
Okay.
Where he was betting against the mortgage industry,
Okay.
and betting that they were going to fail. So if this is a swap, it's betting against something, right? So it's a betting against, and it looks like from what you're saying is these do well during times that the interest rates going down, and inflation's going up, and that's when these do well.
And there are all kinds of forms of derivatives that are really good for us too, and really good in the market that aren't going to be poison pills to us. So derivatives shouldn't be as bad of a word as it actually is.
Oh, it's a 4-letter word nowadays.
Yeah, I know. Yeah, and it has been since 2008. But
so given that this LDI strategy you came across right now in this current situation should be doing very poorly for people.
And as bond prices go down, and they're going to continue to go down because the Federal Reserve is offloading their balance sheet to the tune of trillions of dollars.
But people are buying them.
Yeah, well,
we'll get to that in a second. We'll get to people buying bonds in a second.
Can they buy them fast?
Continue with your point.
I know people are, but can you buy them fast enough in order to mitigate the problems that these new LDI strategies are apparently creating? And they're not new to the UK. They've been utilized in the UK a lot, but they're more new to the United States, thankfully.
So the biggest problem with this is not that they had some bad investments, and the investments are going to take a negative turn for right now. And you're thinking, well, it's a long-term investment, Dave and Brandon. It will go back up. Things will go back normal, and they'll make money again. Well, the problem is that they bought a lot of this on margin.
Yeah.
So it's not money that they had ready. So if it starts going negative, usually what's written in the contract, when you buy a derivative contract on margin, the rules are if it drops below a certain point, that bank gets to say, hey, you need to pay this margin because you are now negative. And we need it's called a margin call. We need that money now. And if the pension fund is losing money here and losing money in other places because the whole market as a whole is going down, now that pension fund's like, I don't have it. Now that pension fund could be put into default, and it snowballs from there. That's kind of, am I right in that description?
That's what it seems like. And it seems like also at the same time, okay, so I know what margin calls are, and you were correct on that. The limited amount of reading, and I'm surprised this isn't bigger news, but oftentimes any financial contagions just come out like this small news at first, and they come out and surprise everybody. And if this is a financial contagion that causes the next financial recession, I don't know if that's the case or not. But the limited amount of reading that I've done, they were essentially shorting interest rates with these things. So they're betting against interest rates. And of course, we all know now interest rates are like going up and going up quickly.
Yep.
It's coming back to bite them in the butt.